Markets continue to navigate a complex environment defined by persistent trade policy uncertainty and a Federal Reserve adopting a cautious stance. On May 7th, the Fed predictably left its policy rate unchanged in the 4.25% to 4.50% range, but Chair Powell's commentary highlighted shifting risks. He explicitly noted the larger-than-anticipated impact of trade tariffs, warning they could simultaneously push inflation higher while slowing growth and raising unemployment, a potential stagflation scenario that complicates policy. Consequently, the Fed remains in a wait-and-see mode, with rate cuts likely pushed back, possibly until September. Looking at the U.S. economy, recent data paints a picture of resilience mixed with emerging weakness. While April non-farm payrolls came in slightly ahead of consensus at 177,000 and weekly jobless claims remain relatively low, other indicators like private ADP payrolls disappointed. Economists note that businesses appear to be hoarding labor for now, reluctant to cut staff despite cooling demand. However, pressures are building, particularly from tariffs increasing input costs. The first quarter saw a drop in productivity and a surge in unit labor costs, suggesting corporate margins are being squeezed, a trend that could force more layoffs if cost pressures aren't relieved. Trade policy remains the dominant theme globally. Recent exploratory talks between the U.S. and China in Geneva haven't yielded substantive breakthroughs, and President Trump has signaled that baseline tariffs, perhaps around 10%, are now a permanent feature of U.S. policy, not merely a temporary negotiating tactic. This stance is having tangible effects worldwide. Chinese export growth is slumping, prompting new stimulus measures from Beijing. In Europe, the Bank of England cited U.S. tariffs as a factor in its decision to cut rates on May 8th, acknowledging the drag on growth. Reflecting this murky backdrop, Wall Street analysts have been busy slashing their forecasts for the S&P wink with tongue sticking out 500. Consensus targets for year-end 2025, which were in the mid-6,000s earlier this year, have been revised downward significantly. Goldman Sachs recently cut its target to 6,200, Barclays lowered theirs to 5,900, and firms like RBC Capital Markets and Capital Economics are now forecasting levels in the mid-5,500s. These revisions reflect concerns about policy uncertainty and its impact on economic growth and corporate profits. Even with these cuts, the market's current valuation, with the S&P wink with tongue sticking out 500 around 5,630, implies a price-to-earnings ratio in the low 20s, still elevated compared to historical norms. So, what's the outlook for investors? In the short term, the market is likely to remain volatile, trading reactively to news on trade negotiations, inflation data, and Fed signals. Market breadth has weakened, suggesting rallies may lack broad participation. Any further negative surprises could easily trigger pullbacks. Longer term, the trajectory depends heavily on whether the U.S. avoids recession, if inflation continues to moderate, allowing the Fed to eventually cut rates, and critically, if corporate earnings hold up under pressure. Potential upside exists if these factors align positively, but the significant risks tied to trade policy and its economic fallout warrant caution and disciplined risk management. Diversification and a focus on quality remain prudent strategies in this uncertain environment.